Right, today I'm going to continue the general discussion about how new loan officers, especially, although all loan officers can help prevent loans from dying in underwriting, and also how they can use their thought process to sometimes save a loan that an underwriter wants to decline initially. Uh, Two specific examples that came to mind or called to my attention this week. One loan was getting ready to close in about 3 days. And then, as the loan officer put it, the underwriter looked at the bank statements and found that the applicant had recently taken out a car lease. And the underwriter, when they noticed that the bank statement showed deductions for the car lease payments, now put the DTI too high and the loan died in underwriting. So this is a common refrain from loan officers who are careless. The underwriter found. Well, loan officer should clearly be looking at the bank statements to see if there are any deductions that are coming out in a systematic amount. And then they need to ask the borrower twice about that. First, before the bank statements come in, do you have any liabilities that haven't been disclosed on the application? And then a second time to actually look at the bank statements. So for the past 30 years, I've seen loan officers complain about borrowers. They tell the borrower, you've got to send in all pages of the bank statement. And a lot of times the borrower doesn't send in the last page, which is blank. And the loan officer is all upset that the borrower is stupid. They don't understand what all pages means. And then when the statements come in, we have loan officers that don't actually look at the statements, don't think about what the statements show. And then when it gets into underwriting, then they're upset that the loan died. So a second loan I'm going to tell you about that I know died in the past week is a topic that there is no guideline for, but it is an issue that is raised all the time. And the first point is when the borrower is going to be moving a long distance away from their place of work. So typically that's 50 miles or over an hour-long commute. But again, if the loan officer sees anything that may be concerning about their time having to go to work, they should first dig further with the borrower and their employer to see what are going to be the terms of their work arrangement. Are they going to be completely remote? Now, if they're going to be completely remote, there's a good chance the underwriter is going to go along with even a very lengthy commute, even an hour and a half each way. But if they are not going to be completely remote, then we want to find out how often do they have to be in work. Now, if it's 1 day a week, probably still acceptable. If it's going to be multiple days a week, 4 or 5 days a week, we also now want to check, does the borrower, say, have family living in the area where they can stay 1 or 2 nights a week, to give that underwriter the feeling that the borrower has a plan to be able to handle this lengthy commute over time. And especially we want to be concerned if there's a newer job that has a much higher pay than the prior job. So even though it may be a totally salaried job and clearly usable, if part of this lengthy commute is going to be a job that was more recently obtained, that's at a much higher rate of pay than the prior job, the underwriter is going to be concerned that if they can't keep up the commute and they have to work closer to home, that they may not be able to obtain a job at the current rate of pay. So they got to raise from $75,000 a year to $125,000. What if they can't keep it up? What if they have to now stay closer to home and live with that $75,000 pay that now doesn't allow them to qualify? But the one special topic that I want to bring up now that caused one of these loans to die, and this was an experienced loan officer, The underwriter was okay with the length of the commute, except the borrower had been receiving overtime, and there was really no question with the overtime itself. It had been earned for many years. It had been earned a steady amount of hours. The employer indicated it was likely to continue, but the underwriter would not allow the overtime to be used for qualifying. Now, we all know none of the agencies speak to not being able to use overtime income that's been earned for a long enough period of time, that's being earned in a steady or increasing amount, and that the employer will say is going to continue. But the underwriter did have the discretion to say, I don't believe that this borrower that's going to be commuting an hour and a half each way into work is going to be able to also keep up the 15 hours of overtime income that they've been doing for the past several years. So as a newer loan officer, you have to train yourself to think like an underwriter. You almost want to think you're getting paid to find a way to not make the loan, because to some extent, really, that's how an underwriter is getting paid. Someone is paying them to make sure that nothing can be questioned when it gets into quality control from their end, or when they pass it up to an aggregator, or it goes up to the agency, that there'll be nothing that anybody can question. So that is a skill that is usually developed over several years, but it's a super important skill for your newer loan officer, especially, to have the ability to think what could go wrong and then to question it. So now I'm going to tell you about one loan that a loan officer was able to negotiate some wording, and one single word allowed the loan to close and the loan officer to make $6,000 and have a very happy borrower and realtor. And before I tell you the word, it came up actually with overtime pay. Now, without getting into every single agency, how long overtime has to be earned to be used, without getting into the discretion that exists often, say, between 1 year and 2 years, or between a borrower who's been earning overtime for a long time in the same industry, but has now moved to a different company in the same industry and is still earning overtime. In any of those situations where there's some discretion, if the employer will say the overtime is guaranteed, that can often tilt the decision of the underwriter to go ahead and give the approval of the loan. Now, most loan officers know that. A new one may not, but a lot of your experienced loan officers know if they can get that word guaranteed. Now, the problem comes in that a lot of employers don't want to put down that it's guaranteed, because they know that if they have some unexpected business slowdown, not saying COVID's going to happen again, but if some other event comes up that ruins their plans and doesn't allow the production to require overtime income, they know they're at risk of getting sued by the employee, because the employee was counting on that money to be able to make their mortgage payment. And if now something happens, problems with equipment, the building gets flooded, they still know that it's a risk that if they don't provide that overtime income, they could get sued. So the one word that this loan officer used to save the loan was, they were in touch with the employer and they asked the employer, will you use the word scheduled overtime instead of guaranteed overtime? And they were willing to use the word scheduled, and the underwriter was willing to accept the word scheduled. And so this is just one little trick of the trade that any loan officer can use to hopefully find a way to save a loan if they come into that situation. Now, I'm going to try to share the screen here. This is only my second live. So we'll see how well this goes. I think it'll be okay now. This is where you can get in touch with me if you're either a new loan officer who is looking to learn underwriting guidelines and structure loans, if you're a branch manager, or you're an officer or an owner at a company, whether you're a bank or a credit union or an IMB, and you'd like me to help train your newer loan officers to properly structure loans, close their loans in 1 to 2 underwriting touches, and also make sure that they don't let any loans slip through that could be made, you can get in touch with me there, and I can give you a look at our entire system and see if we can help your folks out. Okay, that's it for today.